Stocks continue lower today in some indexes more than others, but not to the same extent. So it looks like the bleeding has stopped. What's interesting from this pattern is the buy the dippers haven't come in to the same extent as we have seen in the past. So again, you can kind of see how mature our bullish trends are. So I'm going to break that down from a technical perspective now and say, okay, how does this end of a bullish trend going to look like going forward here? And then what do we do? How do we trade? How do we trade? What kind of things can we look for and set up when we're in a strong bullish trend that pretty much precludes us from being aggressively bearish, but we're also running out of gas, so that precludes us from being too aggressively bullish. So where's the middle? And that's what we focus on in today's trade idea. Let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Wednesday, December the 6th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back day after day. Subscribe to my YouTube channel by hitting that red button that's right down there below the video. Hit that thumbs up that's right next to it as well. Let me know that you found today's video useful. So one click, easy way to give me some feedback there. Scroll down even further and comment on anything that stood out to you from today's video. Also in the video description, there's a bunch of links there, including one for you to join my daily email newsletter that I send out with links, hyperlinks, timestamp summary of what we talk about every day in these videos, as well as a few other goodies in there. Follow me on Twitter for more content in addition to these videos. You'll see my handle on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet from there. Also, join the Market Outlook community by going to Facebook. You see the address at the top there. You also see a link in the description below that will take you there as well. And just click on Join Group. All right, well, after one day of dropping to an extreme low on the momentum line, the intermediate line has dipped its toe below the 80th percentile. So by definition, the intermediate posture is weakly bearish, and it's about as weakly bearish as you could possibly be because it's at 79.5. So it's like you know, your football team's got the ball, but they've got it on their half-yard line, backed up against the end zone. I mean, it can turn. The things can turn bullish that quickly if we just turn back up again. Now, the near-term line is dropped, but still in the reversal zone here. The momentum line still also extremely low. But you notice that we pulled down and basically down to 38% Fibonacci retracement. So again, this idea of a potential near-term bounce definitely still in play for the next day or two, heading into the end of the week with earnings or with jobs report coming out on Friday. I just don't expect it to go up to new highs or for that long like it has all these other times. Eventually we're going to get a bearish near-term high, and the odds are getting higher that we're going to get a bearish near-term high because and a bearish near-term high is a high that's lower than the previous one, where the blue line here peaks between 50 and 80. So the odds of getting one of those are getting higher because we've had good extended, one too long, but we had good solid near-term runs. One when we started off here, two, and really that one, this is a big one here, but it's kind of broken up in half. We just didn't pull back very much there. But 2, 3, 4, it's a pretty decent one there. And you know, the pullback was so small that it kept it above while we were pulling down. And then now 5. So nice, good near-term runs. 3 months into this intermediate rally, nice intermediate trend, but the posture is still bullish, the long-term trend is still bullish. So we're not looking for like a bear market here, and we're just looking for it to grind in this area right in here for who knows how long, while these moving averages that we got so far away from play catch up a little bit. You know, it's kind of hard to extend away when we already are so far away from a lot of these indexes. All right, when you take a look at the Dow Jones Industrial Average, the same thing. But this one, the momentum line still is extremely, extremely low. And remember, extreme lows on these lines signify a change in trends coming. And again, strong bullish postures don't turn into strong bearish postures. They turn into weak bearish postures first, and then they build into stronger bearish postures. But at first, they're still just weak. The NASDAQ composite bounced up a little bit, so a little bit of an engulfing pattern here. The momentum line bounced back up. The near-term line avoided reversal zone. So a little bit of a bounce back up there. Weak bearish posture. So again, we're not looking for big pullbacks here. And this thing can turn back up and be bullish, strongly bullish, just like that. But if and when it does bounce back up, we just don't expect it to go up to new highs or, for a good extended run. It's just probably going to set up and peak right around this area here from a Fibonacci standpoint before we continue to meander in this area. And then finally, the Russell 2000. Take a look at the Russell 2000 here. Down the most today, down below that level that we looked at yesterday that could act as a support. Still an extreme low on the momentum line. Near-term line now dipping its toe in the reversal zone. Not much, but getting down there. It's not bullish when that line gets down there. And, of course, the posture here is bearish. And its market sentiment is dropping and almost down below 82. Which would signify bearish area. Remember, this has had the long lower shadow, long low. The lows of these long lower shadows can act as support. So keep that in mind as we pull back. That there's not much room to pull back before we get a near-term bounce. Just don't expect the near-term bounce. I'm repeating myself, but don't expect that near-term bounce to get up to new highs. Expect it to get in this area, probably around this old high or 1525 before reversing and continuing with this bearish trend. Now, if we bounce off of here into the end of the week, then you'll probably end up with more of a doji type, this kind of pattern here, whether it's red or not. That's kind of how we'll probably end up, a little bit of a long lower shadow again as we are extended away. If we don't and we pull back even further, it will be more bearish if we don't get that near-term bounce and this bearish posture starts to strengthen. That's not what you expect because of the long bullish, the strong long-term trend. But anything can happen, right? So, if it does pull back down into Friday and get down to 2600 or even into this area, there's that dark cloud cover we talked about. But, if we do what we expect, I'll probably get up into this area here and get one of these types of candles, which is typical and very, very much expected when you're this far away, in this case, up above the 50. And, of course, remember, very far up above the 200-day moving average, and the gap between the two large as well. When we take a look at the 3 green arrows, you can see still have 3 green arrows. We don't have red arrow on either one of the MACD or the stochastics. And the MACD is very, very high, and we don't tank from these levels. We didn't break the 8-day moving average today, so keep that in mind about how bearish we've been, and again, why we expect a near-term bounce. Because we didn't break the 8-day moving average. If we do, then don't expect it to drop too much, because you still got the 17 in Fibonacci support and all of these things kind of holding it up. In this case, at least above 2600. And then again, MACD at high levels doesn't tank to zero; it grinds its way to zero. So the expectation is we'll grind in this area as that MACD continues to get lower and lower, and the stochastics might fiddle around up and down a little bit as we do grind, but more into this area down here. All right, so when we look at the intraday move, it's very, very small move, which again is good. We don't like these bigger ranges. They're bigger when they're bigger than average. When they have bigger volume, that's not a good sign. The fact that we've slowed down to a smaller range, and you notice it was a lower high, lower low, but it pretty much finished above yesterday's low point and pretty much within the range, the lower end of the range. You can see the volume at 75 million, but you can also see too, again, when we go into context from a 20-day range, we're still easily up here, and we could still even pull back more. We might not get this near-term bounce, or if we do, and we get up to 265 and we roll over, we can come down to 260.5 and be fine from a bullish perspective, and that's kind of what I expect. Now, if we break 260.5, now we're getting more bearish. But remember, a move down to this 4-week low is just a 38% intermediate retracement. So there's going to be a lot of support in this area too before things. I mean, things are most likely not going to hit the fan anytime soon. There's going to be the opportunity, and when we start to muck around, there's going to be a lot of opportunity for selling premium as things just kind of go sideways, and with I would think a slight bullish bias because of the season, because of the seasonality effect heading into the end of the year. So now we look at this move, the range, 75 million. Again, it's a little bit above average, and that's just a little bit, and we've been here before, so there's going to be some resistance from a volume standpoint here, average volume standpoint. You can also see too, 1 point range is much better, well below this line, and this is kind of at a high. And then you look at the volatility index, it came down, but it's, didn't come down to a new low, and you can see it is you could say that this is a potential new high. That stochastic's not quite below 50 yet, and we can actually change this color to blue since that's the one in progress, and change this one to red. But you can kind of see how it's going sideways. Volatility is going sideways, is not dropping like we've seen other pullbacks. That's why I'm not convinced that we're going to go up to new highs and be significant, unless it's Bitcoin, right? I'm not convinced of that. And of course, on the relative basis, you can see, yes, we pulled back, still above this extreme level. Get below the extreme level, get that volatility back down to 10 or below. Yeah, we'll just grind higher to potentially new highs, and because anything can happen, right? But if we don't, which is what I don't think we will, we'll just kind of mess around in this area underneath those new highs with slightly increase in volatility as we have more of an intermediate pullback than we've ever had for the past few months. All right, now we take a look at what's driving the price action today. And again, quick reminder here. If you're following me on Twitter, if you're not following me on Twitter, remember it's at DavidSettle42. Click the follow button that you'll see right there. But again, I put out a lot of content here throughout the day, so to make sure that Twitter is pushing you that content, come right over here, pinned to the top of my timeline is that like and retweet button. The more you do those two things, the more Twitter will keep pushing that stuff to you, my stuff to you, and the benefit I get out of it is that Twitter will keep pushing this stuff that you guys are liking and retweeting out to everybody who follows me. So I appreciate that. We got above 100 yesterday, so I really appreciate that. We'll take a look, and you can see the biggest movers to the downside today, really the only outliers were crude oil and emerging markets, both significantly movers to the downside. Look at crude oil. Crude oil had been doing relatively positive, but down 2.75%. That's a sharp move. Everything else, you notice, was between a half a percent gain and a 0.5% loss. The biggest loser was small cap stocks, not surprising. The biggest gainer was long-term treasuries. So even though the broad market was flat, see, that was flat there, 0%. The broad market was flat. International stocks underperformed. Gold continued down as the dollar stayed higher. The dollar and long-term bonds. So both of these safe haven assets usually. The dollar's been rallying with with yields. In this case, it was with long-term bonds, which is more safe haven. Now, gold did outperform, equities, and it definitely outperformed gold, and that's a safety relationship there when gold is outpacing crude oil, by that much. Big, sharp move. You can see one of the reasons why crude oil dropped as much as it did. There's multiple reasons, but one of the main one reason is even though there was a draw in inventories, you can see there was a build in the products in gasoline and distillates, which again, the supply might be dropping, but if demand is dropping, of course that's a much bigger issue. You can also see too that from a broader standpoint, economic indicators. We had productivity and costs come out today. Now, this doesn't get a lot of, notice it doesn't have a big red thing, but it does have the green one, which means, merits extra attention. And the extra attention that you get out of it is that, again, when you're in good, bullish, maturing economic cycles, then what you'll see is productivity will be down, right? Because again, you're hiring a lot of people, and productivity gets bigger. You can see when the market's at the end of a economic cycle. There's a lot of layoffs. There's not as many people working. They're getting more stuff done because they have to. And labor costs go down because people are getting laid off. Labor costs start to go up again. As we bounce back. You can kind of see an inverse relationship here. Productivity goes down, but labor costs go up. That's a sign of a growing, healthy market. As we start to get more and more people, we'll look that productivity starting to ramp up again, and unit labor costs starting to go down again. So again, it's kind of a sign that that labor market, which we did get the ADP numbers out. That labor market has been so strong for so long, starting to show some signs of weakness because again, that wage growth, which is really what pushes investor sentiment and consumer sentiment and all that, continues to be down, and productivity, which usually is very bearish when things are going really great, not very bearish, but flat to negative, slightly negative, has actually been growing, which usually there's that relationship with kind of a worsening employment market. All right, so just as we saw kind of a move to safety on the asset classes, we also see it too here. Now, industrials is showing some relative strength still. That's been a common theme here last week or so. Well, last couple of weeks, when you zoom out, you can see industrials has been really strong. But look at one of the new leaders in the clubhouse here over the last couple of weeks now is consumer staples. So consumer staples, which had been really lagging, I mean, look at that strength. Look at that move higher here. Now up almost 4% over the last couple of weeks. Outpacing consumer discretionary. Now, that's not a typical risk-on relationship. Here's the relative strength chart of XLY to XLP. And you can see, I mean, here's the election right here. XLY has been just killing it against XLP. Not this week. Showing some weakness here, and over the last couple of weeks showing some weakness. And we see that showing up here on the relative strength chart. Technology, of course, bouncing back up. You can see how it's still weak way on down there. Bouncing up today. Today, your biggest winners were against staples, utilities, technology, but don't put a lot of stock into that, right? Because of how low it was heading into today. And not surprising that energy, which, we looked at a trade on energy on Halliburton here for a long-term position. So we're willing to ride out some short-term swings, as long as it doesn't break support that we were coming up off of. Whereas on the other end of the spectrum, some other relatively recent strength has been, materials and, with gold continuing to be weak, and a trade we looked at yesterday in that area, and consumer discretionary, again, way outpacing today, lagging behind consumer staples. Everything else kind of matching the market. Healthcare's there, real estate's there, financials, there. So don't, again, that kind of tells you don't put a whole lot of stock into the move in the yields with the bonds dropping as much as they are. Those interest rate hike expectations. I don't think I showed you those. The interest rate hike expectation. This is for March. So here is a this is for no rate hikes in December. This is for the one rate hike in December, but nothing else. This is for a rate hike in March. And look how it's, okay, well, we got one in December. Maybe we get one in June, right? That was the idea. Well, now the odds are higher that we'll get a rate hike in March more than we won't. So, in fact, it's above 50-50 now. If I were to go to current, I believe, let's see here. Yeah, it's just barely, but above 50-50 that we'll get a rate hike in March. So that's a big change. Again, if you look at, this one-day chart, we're at 55%. A month ago, we were at 45%. And you can, of course, you can see that on this chart, on this historical chart, where we were a month ago. I mean, look at this thing. In this September, there was no chance at all. In fact, the best odds were that we weren't going to get anything in December at the beginning of September. My, have things changed. In fact, again, from a sector rotation standpoint, if I were to go back here, let's go back 3 months. There we go. You can see, financials have really benefited, and they've been the biggest winners from this whole standpoint. A lot of it early, a lot of these gains early. You can see technology had been a big winner during this rise in interest rate hike expectations, whereas your safe havens have been laggards. But look at this, relative strength and consumer discretionary or consumer staples since the beginning of since about a month ago. Consumer staples up over 8%. Discretionary doing well too. So consumer stocks as a whole doing very well, but staples has been the one that's been killing it more than anybody. A little bit of a safety move early in November, right? And then once we hit the middle of the month, the safety areas lagged, the market bounced back up. But you notice while utilities came down and real estate came down and lagged, staples didn't. It continued higher and higher and higher. If we take a look at the long-term chart of staples on an absolute basis, and look at that chart breaking up to new highs as a sector, breaking up to new all-time highs. Remember, the market is not breaking up to new all-time highs. In fact, it's not even close, nor do we expect it to break up to new all-time highs. And again, you go back to XLP and look at linear regression for this area. It's got it had been lagging, and it's got some room to run. That's the 5-year chart. You can see it's not like it's abnormally bullish here. And then you take a look at the 1-year chart, it's still got some room to run too before it gets abnormally bullish. I mean, look at that run in staples. It's on the daily chart here. So you can see how the market, again, we don't have to tank, but you can see how there's rotation into potentially what a lot of investors may see as kind of a safer area if we were to have an intermediate pullback, an area that might hold its value better because it had been lagging the market. I look at a left scale here and look at the broad market as a whole. Since that time frame right here, when XLP peaked and we continued to drop, well, right there, this is where the S&P was at. What would that be? 2430-ish in that area. By the time we got to this point, the S&P was all the way up to 26. So, it was not being led higher by this, but from that area, from that point, the S&P did make a new high, and nice good run there for XLP off of that linear regression low point during this pullback. When the S&P rallied, XLP went sideways, and now that we're getting a pickup in volatility here, a lot of movement, a lot of rotation movement into a safer area. All right, so for our trade idea of the day, I want to take a look at Apple. You can see how Apple has been bullish, right? We did go up to new highs. We've been kind of grinding here over the last few weeks with that MACD coming slowly down to zero, similar to how the broad market does it. You'll notice that when I look at just the actual indicators here, the arrows on these indicators, it looks like there's a possibility we could bounce off. We've seen this before. We've kind of grind and we bounce and we grind. We might come down a little bit, but not break in support or anything. So it's like, okay, well, if we kind of grind, and we don't expect this to go up to significant new highs, right? Because the broad market and this has been losing its leadership, losing its luster a little bit. If we were to pull back down a little here, then we can say, okay, well, what if we set up, because you see how its options are relatively expensive. So we can sell options on both sides of this as we kind of grind away, as the broad market grinds away. So we could sell the 160, buy the 155, come over here, sell the 180, buy the 185. I'm selling these with these lower deltas, getting a pretty decent credit, probably end up somewhere in the middle here. But then so you can see that's what we have set up there. There's my break evens, decent odds of success. And then when I put those break evens on the charts, that's where those lines came from here. There's my break even to the upside, so I've got some room for it to even go up to a little bit of a higher high. There's my break even to the downside, lots of support in this area around 160. So it can just muck around here now, and we'll be able to take advantage of that with this kind of iron condor, where we're selling the call and sell up here, so we'll make money if it stays below that. We're selling the put down here, so we'll make money if it stays above that. I can only lose maximum loss on one side, not the other. So it's like I'm getting two vertical credits for the risk of one of them, for the risk of only one of them. But again, we're taking, it's a lower probability because than a regular vertical, because now we've got two break evens than just compared to just one break even, which you have on a regular vertical. But again, we offset that with the credit of a second vertical without the risk of a second vertical, with the risk of only one vertical. So that's how this iron condor works, and it's a great opportunity when we don't expect the market to go anywhere, right? That we near-term bounce and mucking around, and this is one of the bigger stocks in that area, and we can take advantage of those relatively higher premiums compared to normal, even though the actual sizzle index You know, there's not a whole lot of volume going on. It's not like the market's ramping up or too crazy. Even the volatility sizzle isn't too crazy either. So the market's not ramping up for any big event here on Apple by the time we get to that January expiration date. In fact, if you take a look at the next earnings call is in the 29th. So we'll have the expiration for the 19th before we get to that level. You know, and again, you know, there's seasonality, there's ups and downs in the seasonality for this time frame, and the market's been very mature, so we can kind of up and down here for all we care, as long as we stay in the middle, kind of in this middle area where we are right now, with the MACD grinding all the way down to zero here. So there's not a lot of momentum really one way or the other. And that's the setup you look for when you're looking to sell both sides instead of just selling one side, which you do with the individual vertical spreads. So to summarize, the market continued a little bit lower today, but not, you know, significant lower high, lower low that we would expect it to pile on, right? The market posture for a lot of these indexes are all weakly bearish right now. They're backed up against their own end zones. You know, there's a great opportunity here for a short-term, near-term bounce that we just don't expect to be a long-lasting, a normal one, right? This is one that we think, okay, you know, it's going to be, and there's a higher odds it can be a bearish bounce in terms of not bouncing up to new highs and kind of mucking around here. That's okay because we have been bullish for multiple months now. We need more of a breather, and that more of a breather doesn't mean that we have to tank to get that breather. We can just kind of muck around and go sideways, and that's okay too. And that's the situation we're in because of how strongly bullish these long-term trends are. So while we're kind of mucking around, not doing anything, with a slight bullish bias to the upside because of the seasonality, there's a trade that we can take advantage of that we did with today's trade idea. So we don't have to do nothing, right? There's still good opportunity to make money in areas when the market just doesn't go anywhere, and that's what we tried to highlight. So again, thank you very much for watching tonight. I really, really appreciate your time. Remember to subscribe, like, and comment on the YouTube video. Also remember to find me on Twitter for more content. Follow me there and like and retweet the content that you see, including tonight's Market Outlook tweet that's pinned to the top to make sure Twitter keeps pushing you that content. And if you haven't already, join the group. Join our Market Outlook group, our community on the Facebook group with that link down in the description. So again, thanks everyone. Have a great evening. We'll see you all tomorrow.